Hi, welcome to my channel. I'm not here to take up more of your time than necessary. I'm here to give you exactly what you need, fast. Today, we're going to talk about one of the most powerful investment strategies, dollar cost averaging, or DCA. We'll go through a short overview of what I'll cover. 1. What is dollar cost averaging? 2. Which assets are better to invest in, individual stocks, Bitcoin, or an index? 3. Does DCA work in different market conditions? 4. And, most importantly, how much money could you have earned by investing $100 each month from 2000 to 2025? First things first, let's define dollar cost averaging. This is a strategy where you invest a fixed amount of money at regular intervals, regardless of the market conditions. Let's walk through an example to see how dollar cost averaging works. You're investing $100 every month in a stock. In the first month, the stock price is $10. With your $100, you can buy 10 shares. In the second month, the stock price drops to $5. With your $100, you can buy 20 shares, more shares for the same $100. Now, in the third month, the stock price jumps to $20. With your $100, you can only buy 5 shares, so fewer shares this time. Now, let's calculate the average price. You spent $300 in total and bought 35 shares. The average price per share is $300 divided by 35 equals $8.57 per share. By sticking to this strategy, you're buying more shares when prices are low and fewer shares when prices are high. Over time, this helps smooth out the ups and downs of the market, reducing the impact of short-term volatility. Instead of trying to time the market, you're investing consistently, no matter what's happening in the market. Now, let's talk about where to invest. Should you go for individual stocks, an index, or Bitcoin? Individual stocks can give you high rewards, but they come with higher risk. You might buy a stock that dips and never recovers, which could be a big loss. For example, let's say you decided to invest in a company that seemed promising at first, but ended up not performing well. Let's consider Intel in the year 2000. At that time, Intel was a giant in the tech industry. Everyone thought of it as the leader in semiconductor technology. Its stock was soaring, and many investors jumped on board, thinking they were getting in on a winner. However, 2000 marked the peak of the dot-com bubble. While Intel was a strong company, the tech sector as a whole was overheated. Investors were pouring money into tech stocks, often without looking at the fundamentals of the companies themselves. As the bubble burst, Intel's stock price, which was around $70 per share in 2000, dropped significantly. By the end of 2002, the stock price had fallen to around $20 per share. If you had bought Intel at its peak in 2000, you'd have seen your investment lose more than 70% of its value over the next couple of years. Despite Intel's strong position in the market, it was still impacted by the overall market downturn. Even though Intel eventually recovered and grew over time, the stock price didn't reach its 2000 peak again for several years. If you had been holding on to Intel shares during that time, you would have experienced a significant loss, and it could have taken a long time to recover. This is one of the risks of investing in individual stocks. Sometimes, even the strongest companies can get caught up in market cycles. A company can seem promising, but when a broader market bubble bursts, its stock might not recover quickly or might take years to return to its former highs. But if you pick the right individual stocks, you could see massive gains. Take Apple, for example. Back in the early 2000s, Apple was still in its early stages of growth. In 2003, Apple's stock price was around 30 cents per share. Fast forward to 2020, and Apple's stock price is over $130 per share, a significant increase over the years. If you had invested $100 in Apple back in 2003, you would have purchased about 333 shares. By 2020, those 333 shares would have been worth over $43,000, giving you more than a 430-fold return on your investment. Apple is a great example of the rewards you can get from investing in the right company. They had strong leadership, innovative products, and a loyal customer base. Those factors helped drive long-term growth, making it one of the most valuable companies in the world. One of the challenges is picking the right stock and holding it long enough to reap the rewards. The problem is, most people can't predict which stocks will perform like Apple. Now let's talk about Bitcoin. Bitcoin is a unique asset. It's one of the most exciting and volatile investments you can make. In fact, it's had some of the biggest price swings in history. Let's look back at 2017, when Bitcoin surged from around $1,000 at the beginning of the year to nearly $20,000 by December. That's an incredible 2,000% gain in just 12 months. If you had invested $100 in January 2017, it could have been worth over $2,000 by the end of the year. But then, 2018 came, and Bitcoin's price crashed back down to around $3,000 by the end of the year, a 85% drop from its peak. If you were holding on to Bitcoin during that crash, your $100 investment would have been worth only $15. This is the nature of Bitcoin: huge rewards when things are going well, but also huge risks when the market turns. Its price can swing wildly in a short period, which can be exciting for some investors but terrifying for others. Now let's take a look at how the S&P 500 has performed over time. While individual stocks can have dramatic ups and downs, the S&P 500 has shown a remarkable ability to recover from market downturns. Let's focus on the 2008 financial crisis. The market took a huge hit, and the S&P 500 lost more than 50% of its value. If you were investing during that time, it would have been tough to watch your portfolio shrink. But here's the thing: the S&P 500 recovered. By 2013, just 5 years after the crash, the S&P 500 had regained all its losses and started hitting new highs. By the end of 2020, it had more than quadrupled its value from the 2008 lows. That's the power of a diversified, broad market index. Over time, it has the ability to recover from even the deepest downturns. If you'd invested in the S&P 500 at the peak of the 2008 crash, you would have experienced some tough years. But by sticking to your strategy and holding through the recovery, you would have been handsomely rewarded. Unlike individual stocks, the S&P 500 gives you exposure to a broad range of companies, which helps smooth out the rough patches. Even after big market crashes, the S&P 500 tends to recover, driven by the growth of its diverse companies. The S&P 500 is a prime example of how index funds can be a powerful tool for long-term investors. While you might not see the same huge returns as with a single stock like Apple, the S&P 500 provides a more stable, diversified way to invest. And the best part? It has consistently recovered from downturns, making it a safer choice for most investors. Here's the big question: does dollar-cost averaging work in different market conditions? The answer is yes, it does. In a bull market, when prices are rising, DCA helps you avoid putting all your money in at the peak. Instead, you've been consistently investing, so you're buying in at lower prices before the big gains. And when the market is down, DCA works even better. You're buying shares at a discount, which means you'll have more shares when the market eventually recovers. So, whether the market is up or down, DCA helps you stay on track. Now let's see the results of sticking with a dollar-cost averaging strategy over a longer period. Imagine you've invested $100 in the S&P 500 every month consistently for 25 years. That means you've invested a total of $30,000. But here's the incredible part: your investment grew to $112,130. That's the magic of staying consistent, even during market ups and downs. Here's why this works: when the market dips, you're buying more shares for the same amount of money. When the market goes up, those shares are now worth more. Over time, this strategy lets you take advantage of the market's natural growth while smoothing out its volatility. By sticking with this approach, you avoid the stress of trying to time the market, and you let the power of consistent investing work for you. With a total investment of $30,000, you've turned it into $112,130, proving that steady contributions and time are your best allies in building wealth. Thanks for watching. If you found this video helpful, don't forget to like and subscribe. Remember, investing is a long-term game, and with strategies like dollar-cost averaging, you can ride out the market's ups and downs to build wealth over time.